Now we're going to go through some quick hits, some of the ideas perhaps that some of you watching today have found interesting in the news, perhaps in the media. First one, TSX outperforms US markets. Yes, that's not an error. The TSX has actually outperformed the US markets since the beginning of the summer. And why has that happened? And how has that happened? We'll talk a bit about that. Stocks are in and bonds are out. Bloomberg Markets Live Pulse Survey. So what does that tell us? Tells us that investors are now perhaps selling off their bonds and moving money more into the stock market. I know it kind of went the other way for a little bit there. As interest rates moved higher, people could get a higher rate on their bonds or GICs, and that rate was over 5% at one point. Now it's well below 5%. Probably can get something in the vicinity of 4.5, and I would not be surprised to see that number fall below 4% in the not so distant future. So we'll touch on that. Chinese stock market surges after government stimulus. This happened not too long ago. The Chinese market surged quite a bit in the last few days, and that is on the back of this pretty large China stimulus. Government basically stimulated their economy, cutting interest rates. We'll talk a bit about the Chinese economy and how it's been faring. So let's talk about the first one. TSX outperforms the US markets. And our first chart here that we have, we can show the TSX, and you can see clearly how well the TSX has done. So why has it done so well? Here it is, 24,000 points, a number that basically all-time highs never seen before. Well, our next chart is on oil, WTI. I can tell you it's not because oil prices have gone up. And recently, the Saudis and OPEC in general have talked about raising their output quota, raising oil. That has been what we're hearing. If the Saudis and other countries start to raise their output, I think it was just this morning that Saudi Arabia said we could see oil, WTI oil, which is North American oil, we could see that maybe as low as $50 a barrel. What would that mean to filling up all our cars here in Canada and the US? I think it would be a fantastic thing. If the world starts pumping more oil, then what does that mean for even inflation? Perhaps inflation even falls further. So WTI falling, oil prices falling. We know oil makes up a very large component of the TSX. So that hasn't helped the TSX move higher. But what has? Let's go to our next chart. Our next chart is gold. And anybody who has owned gold, they've been on a great run. As many of you know, I'm not a gold bug. I don't have gold really in any of my portfolios. And it's been something that it's just because I have trouble wrapping my head around why gold prices move higher. You know, we don't use gold for manufacturing. We don't use gold. It has really no industrial use. The only time you see gold is around people's wrists or necklaces, bracelets. People use, or central banks buy gold as a hedge against the US dollar and a hedge against, I guess, a little bit of chaos in the world. So what's happening now? Well, Fed's cutting rates. US dollars falling, gold is a hedge against that. So gold prices are moving higher as the US dollar moves lower. At the same time, we are seeing some panic in the world right now. We're seeing conflict in the Middle East and other places. We're seeing a lot of conflict between the United States and China. So that has also been a catalyst for the price of gold. So definitely materials, gold prices are been a catalyst for the TSX and other base metals, as well as we see China stimulate, Chinese economy perhaps going to start moving or growing more. That is also good for materials, base metals, which is good for Canadian stock market and Canadian economy. Third biggest sector, or actually probably the biggest sector, I should say, on the Toronto Exchange, the TSX, is banking. And we have a chart on Canadian banks. It is the largest sector. Oil and materials or gold follow right behind it. These three sectors make up well over 70% of the TSX. And you can see how well bank stocks have done over the past little while. That has definitely helped propel the TSX higher. Royal Bank at all-time highs, CIBC at highs. You know, we're seeing National Bank at highs, and even Scotiabank at 52-week highs, not at all-time highs, still has a little ways to go there. TD Bank has been moving higher recently. Even BMO off its recent lows, some of the downgrades that Bank of Montreal has had, we're seeing that stock move higher as well. So this has all helped the TSX outperform. And will this outperformance continue? I'm not so sure. I think we're going to see a tech resurgence at the end of the year as interest rates fall in the United States. And I think that will help propel the US markets a little bit more than our Canadian markets. The next quick hit that we have, stocks are in, bonds are out. And as I said earlier, why is that? Well, I think simply put, I think bond interest rates are going to come down. GIC rates are going to come down. Bond rates are going to come down. And on top of that, why would anyone want to own stocks at this time? Well, we're about to enter into the best time for the stock market of the year, of the calendar. And November, December, January tend to be the best months of the year to be an investor. And we have a chart that clearly shows this. Average percent change in each month. You can see on the far right-hand side how well the market does on average in October, November, and December, the last 3 months of the year. You can see how poorly September does, but yet this September, markets went higher. So there you go. So obviously, the past is a great indicator for future, but by no means is it something that we should take as gospel. That will happen every year without fail. We do know September over the last few years, I think 3 in a row, went down. This year was the exception. Our next chart that we have, we showed it earlier in the show. This just clearly shows what I was saying about interest rates coming down in the future and why individual investors are saying, you know what, maybe it's time to either hold on to maybe some of our longer term bonds because they still will lock in a higher interest rate, but short-term instruments, short-term money market instruments, short-term bonds, those 30, 60, 90-day paper treasury bonds will start to come down, and they already have. And a quote that we have here, I believe we can show this quote. The Fed has room to cut, as do many other central banks. That sets up a good backdrop for the economy and the US market in particular. That doesn't erase the tightness of valuations, but makes them more justifiable. So what this quote is saying is that rates are coming down. That makes valuations, which we know are a little bit stretched right now, the North American markets, makes them a little more justifiable, and it makes us a little bit more eager to put money into the stock market. The third quick hit that I wanted to talk about is again about China. And recently, China stimulated their economy quite a bit by lowering interest rates. They've done other things in the past, perhaps allowing businesses in real estate in the past by doing different things. The Chinese central bank has done many things to try to stimulate the Chinese economy. And why is that? Let's take a look at our first chart. Because China has been missing their growth targets for quite some time. Take a look at the blue dots. Really, all you need to see is the blue dot. That is their actual growth. And you can see how much it's come down, sub 5% now, most recently has come in just at the 5% mark. But the median forecast by economists, which is the yellow dot, has it actually just under 5% growth. A number that, wow, I guess back in 2006 to 2008, when that dot was almost at 15% growth, we've come a long way, or unfortunately for China, they've come a long way to the downside in terms of growth. So China stimulated their economy by cutting interest rates. And what did it do to the markets? Let's take a look at the next chart. It made their markets move steeply higher, significantly higher. You can see here that the Hong Kong Hang Seng, which is the blue line, highest. China blue chip stocks moved high. Shanghai Composite, MSCI Asian Pacific, all moved significantly higher on a Chinese interest rate cut. So I think that was good for the Chinese market, obviously, but also good for the Canadian markets and anyone to do with commodities. And I think the overall global growth story, I think, will benefit from a Chinese interest rate cut.